In venture capital, choosing the right focus areas is critical to building a successful investment strategy. Unlike hedge funds or private equity, where investments are spread across various asset classes, VC funds must specialize, whether in a particular industry, technology trend, geographic region, or stage of investment. A well-defined focus helps VCs differentiate themselves, attract the right founders, and maximize returns by leveraging expertise in a niche market. But how do investors decide where to focus? It all comes down to trends, geography, and expertise. Venture capital thrives on anticipating the next wave of innovation. The best investors don't just look at what's hot today, they identify emerging trends before they become mainstream. For example, in the early 2000s, social media and mobile technology were high-growth areas. By the 2010s, venture capital had shifted toward AI, fintech, and blockchain. Today, new frontiers like climate tech, quantum computing, and biotech are attracting billions in investment. Successful VCs don't just chase hype. They study macroeconomic trends, consumer behavior, and technological breakthroughs to predict which industries will create the next billion-dollar companies. For example, Andreessen Horowitz was an early investor in crypto and Web3 before the space became mainstream, positioning itself as a leader in blockchain investing. VCs have to follow innovation, but stay disciplined. Investing in the right trend too early, before market adoption, or too late, when valuations are inflated, can be risky. Venture capital used to be heavily concentrated in Silicon Valley, but today, innovation is happening all over the world. Some VCs focus on specific geographic regions where they have deep local expertise, government incentives, or access to strong deal flow. Others adopt a global approach, seeking high-growth opportunities in emerging markets. Venture capital firms often follow key geographic investment strategies, with different regions offering distinct advantages for startup growth. Silicon Valley and the United States remain the global hub for technology startups. The region benefits from strong founder networks and deep capital markets, making it the most established destination for venture capital. Europe is home to a growing startup ecosystem, with major hubs in cities like London, Berlin, and Paris. These ecosystems are supported by robust government incentives for research and development, which help fuel innovation. In Asia, particularly in China, India, and Southeast Asia, venture capital firms are drawn to massive markets and a booming middle class. However, these regions also present complex regulatory landscapes that require careful navigation. Latin America and Africa are attracting increasing attention due to their high growth potential in areas such as financial technology, e-commerce, and digital infrastructure. These mobile-first economies offer strong opportunities for early-stage investment. Some VC firms specialize in frontier markets, where startup ecosystems are less saturated, while others stick to established hubs where exits are more predictable. For example, Sequoia Capital expanded aggressively into India and Southeast Asia, betting on the rapid digital transformation in these regions. Consequently, for VC's geographic focus should align with access to deal flow, regulatory understanding, and potential exit opportunities. Some venture capital firms choose to differentiate themselves not by focusing on a specific industry or geography, but by developing deep expertise within a particular sector. Investors who bring operational knowledge, founder experience, or technical background often gain a competitive edge when working with startups in complex or specialized fields. For example, there are investors who specialize in deep tech and artificial intelligence. These individuals often hold PhDs in AI or have worked in leading research labs such as OpenAI or Google DeepMind. In the biotech and healthcare space, many investors are former doctors, scientists, or pharmaceutical executives. Their understanding of clinical development and regulatory hurdles is invaluable to startups operating in these highly regulated industries. Fintech investors frequently come from backgrounds in banking or payments. Their prior experience helps startups navigate financial regulations and understand the complexities of the global financial system. Startups often prefer investors who can offer more than just capital. They seek out mentors who truly understand the unique challenges and opportunities within their industry and who can provide guidance that is both strategic and grounded in real world experience. A remarkable example is Lux Capital, which focuses on hard science and deep tech startups, leveraging its team's expertise in physics, robotics, and synthetic biology. As suggested by these examples, specialization in a niche industry can help attract high-quality deals and provide meaningful value beyond capital. A successful VC firm doesn't just pick one focus area, it strategically combines trends, geography, and expertise to build a unique investment thesis. For instance, a VC firm might focus on AI startups in Europe, leveraging its expertise in machine learning and access to European R&D talent. Another firm might specialize in fintech in Latin America, where digital banking is booming and regulations are evolving. Bessemer Venture Partners, for example, uses a roadmap strategy, deeply researching a specific industry before making investments, ensuring a well-informed approach. The final takeaway is clear: great venture capitalists don't invest randomly. They carefully define focus areas that align with their expertise, market trends, and access to the best founders. By identifying the right mix of trends, geography, and domain expertise, VC firms position themselves to make smarter investments and generate better returns in a rapidly evolving startup landscape.